So good evening to all the members gathered here of both Tiruchirappalli branch and Kumbakonam branch. We are happy to invite you all for the Union Budget Analysis Seminar 2021. We are having the speaker and we are thankful to the speaker, CA Dr. Girish Ahuja sir, for accepting our offer. So now I request our chairman, CA Paramasivam of Tiruchirappalli branch, chairman, CA Paramasivam, to give the welcome address and also give the speaker introduction. Over to you, sir.
Thank you, Arun sir. Respected sirs, today's our chief guest, CA Dunga Jain sir, SAH chairman, session faculty CA Dr. Girish Ahuja, CA Visagam chairman of Kumbakonam branch, past chairmen, senior members, friends and colleagues. On behalf of the managing committee member of Tiruchi and Kumbakonam branch. Good evening to all. Today's topic is 2021 was presented by the Honorable Finance Minister Nirmala Sitharaman on 1st February 2021 in the Parliament. This year budget places focus on the 7 pillars of review: economic, health and well-being, physical and financial capital and infrastructure, includes the development for aspirations in India, innovation and R&D, and minimum government, maximum governance. Several regulations around the security market are proposed to be merged as a single code. Several direct taxes and indirect tax amendments were also proposed. Some direct tax proposal amended. There is no change in the tax law for individual HUF, homes, etc. IT relaxation when senior citizen of 75 years and above. Reduction in the time for IT proceeding. National faceless income tax appellate tribunals under disallowance of Provident fund contributions. Without a sound budget policy, there can be no sustainable social welfare system. No funds for a proper education policy and no space for durable economic growth. Therefore, I think that effort to the reform and the improve national budget system is one of the best things a social-minded government can pursue. I think today's session is very useful to the members. Is our chief guest Dukar Jain not unable to attend the meeting? He sent one video. Arun sir, can you telecast that video, sir?
Friends, very happy evening to all of you. At the outset, let me congratulate Tiruchirappalli branch and Kumbakonam branch for having arranged an important CP meeting on the Union budget. In fact, I must compliment all the branches of the SARC who have actively been serving its members and students in spite of all the difficult times what we are facing. And I would also like to let all of you know that SARC has bagged the Best Regional Council Award, including 11 more branches. So there have been 13 plus awards this time for SARC. So I take this opportunity to thank each and every member of SARC. It's a proud and big moment for us because we have got this after a span of 10 years. And I could not join you live because there is another commitment at 5 o'clock. So I thought at least let me share the message with all of you. I'm just looking forward to connect to everybody at some other time in physical mode. And I'm very, very happy to see that our beloved speaker, CA Dr. Girish Ahuja, is taking part in this Union budget meeting. He is the Bhishma Pitama of income tax, and the analysis what he makes kind of even makes the government redo things when it comes to final proposal. So I look forward to listen to him, maybe in the video mode, with the recording mode later, and wish everybody a very happy learning. Thank you.
Thank you very much, TC Sain sir, for valuable wishes. Thank you, sir. I introduce our session faculty, CA Dr. Girish Ahuja, and a few words about the team. He did a graduation and post-graduation from Sriram College of Commerce, Delhi, and was position holder. He was awarded PhD degree by Faculty of Management Studies, New Delhi, Delhi University. He is a fellow of Institute of Chartered Accountants of India and was a rank holder of both intermediate final examination of the institute. He had been nominated by the government to the Central Council of the Institute of Company Secretaries of India for last 6 years. He is a special invite to the Direct Tax Committee and International Tax Committee of ICA. He is also board of directors of many reputed companies and has vast in rich experience in the field of financial and taxation. He has also been nominated by the Government of India as independent director of the Central Board of State Bank of India. He attended more than 4,000 seminars organized by the ICA, ICS, ICWA, Chamber of Commerce. Once again, thank you. Once again, welcome to all, sir. Please continue the session, sir. Thank you, sir. Thank you very much.
Good evening to everyone. Chairman of the Trichy branch, CA Paramashivam, CA K. Vishwan Kumbhak, Mr. Arun, ladies and gentlemen. Well, friend, regarding this changes in the finance bill relating to direct taxes. This is a very technical budget. Already pointed out by Mr. Paramashivam that there is absolutely no change in the rate of tax. We were not expecting also the change in the rate of taxes. There was no chance of doing it. No concession, as a matter of fact. It remains the same. But everybody was wondering, they may not put COVID tax or COVID cess. It is not there. So coming back now, discussion clause by clause on income tax. You know, there was a judgment of Swim Securities Limited where they said, although the definition of intangible asset do not include goodwill of a business, but goodwill of business is an intangible asset and we will allow depreciation on goodwill of a business. That was the idea. This judgment came about 5-6 years back. Now they have overruled this judgment, stating that I go to the definition of intangible asset. It says intangible asset is the property of any intangible asset is a group, is technical, being technical know-how, patents, copyrights, trademark, licenses, franchises, or any other business or commercial right of similar nature. This is what is intangible asset on which you are charged. You make one block and charge 25% depreciation. Now, what they have said? Intangible asset being technical know-how, patents, copyrights, trademark, licenses, franchises, or any other business or commercial right, and they have added not being goodwill of a business or profession. So they have removed the definition. In the definition of intangible asset, they have excluded goodwill of a business or profession. Similarly, in the definition of block of asset, they have removed goodwill of a business or profession by excluding it specially from the definition of intangible asset. Meaning thereby, now on, you will not be allowed any depreciation on goodwill of a business or profession. You have been allowed so many years because of Supreme Court decision. Suddenly, they have overruled the judgment and very clearly said that no goodwill, no depreciation on goodwill of a business or profession. You know, in the corporate houses, there have been so many takeovers, so many acquisitions, there is merger, you have what you call some sale, etc. And in that case, you don't pay only the price of the assets, market value of the assets and liabilities, you also pay for goodwill. Now, if you acquire goodwill, you will not be allowed any depreciation, whether it is goodwill of a business or a profession. So this is what has changed now. And they have said goodwill can be of two types. One is self-generated, another is goodwill purchased by you. If you purchase the goodwill, the price is the price which you have paid. The cost of acquisition of goodwill is the price which you have paid to acquire that asset. But if you have not purchased that goodwill, it is self-generated. They have already said cost is nil. Cost is nil. There is no question of depreciation when cost is nil, because you are not allowed market value as on 1st April 2001 as the value, as the cost of acquisition. So therefore now, any time, now if you buy any goodwill, no depreciation. If it is self-generated, cost is otherwise nil. Now goodwill will stand in your balance sheet. It will not be written off and you will not be allowed any amount. I'm not talking about accountancy, I mean income tax I'm saying. Any amount of goodwill which you pay will not be subject to depreciation. Now another point, earlier goodwill of a profession, if self-generated, was not covered because of BC Sirvan case. Now, even goodwill of a business or profession, if it is self-generated, the cost is going to be nil. And since cost is going to be nil, the entire amount shall be treated as capital gain. So this is what they have said. Section 211, Section 51, Explanation 3, Section 50 and 55 they have changed, and they have brought this change. So any question on this? I can take up the question simultaneously instead of waiting for the session to be over. If you have, you can raise your hand. Otherwise, we'll proceed to the next one. So this is first thing which I've told you. Now, if no question, I'm proceeding. You know, the insurance, when you take life insurance, we never used to call life insurance as the capital asset. Because capital asset, the capital gain arises when you transfer that capital asset. In the case of insurance, you don't transfer. It gets matured and you get the payment back from the insurance company. So we have a section called 1010D, which says any amount received from insurance company, including bonus of that, shall be fully exempt if certain conditions are satisfied. The condition is the amount of the premium paid should not exceed 10% of the sum assured. In one case, it is 15 also when it is disabled employee. Now, what have they said? Now they have said there is a new kind of a policy. We call that policy as unit linked insurance policy. Please note the word unit linked insurance policy. It's not unit linked insurance plan. It is ULIP, unit linked insurance policy. It has two components. One is the component of investment. The another is the component of insurance. When you make the premium, both are there, both are invested, and you get a better amount after the time of maturity. Now, what have they said? That the provision of section 1010D, in 1010D it is written, and payment from insurance company is fully exempt. They say provision of 1010D shall not apply if you have taken a policy, ULIP policy, on or after 1st February 21, only about 7-8 days back. If you have taken a policy, 10 days back rather, if you have taken a policy on which the policy is unit linked insurance policy and taken on or after 1st February 21, you will not get exemption under 1010D. You will not get exemption under 1010D if the amount of premium paid in any of the previous year before maturity, any of the previous year, exceeds rupees 2,50,000. Now, what I'm trying to explain, if any of the previous year you have made a payment of more than 2,50,000 as premium, kindly note the insurance policy, when you receive payment on maturity, it will not be exempt. It will not be exempt. Then what have they said? We will treat this insurance policy as capital asset. We'll treat this policy as capital asset. Now, since it is a capital asset, obviously, when you transfer that capital asset, there is going to be a capital gain. But wait, in the case of insurance policy, there is no transfer. You get the money at the time of maturity. So what they have done? They have inserted section 45(1)(b). They have inserted section 45(1)(b) saying that where you have taken an ULIP to which proviso 3 is not applicable, proviso 4 is not applicable, or it is applicable, sorry. That means you have paid premium more than 2,50,000. In that case, the capital gain will arise in the previous year in which the amount is received from insurance company, because there is no transfer. The word is amount is received from the insurance company. You will take capital gain tax, and for the purpose of computing capital gain, the whole amount you receive from the insurance company will be treated as consideration price. And what is going to be the cost of acquisition? The total premium paid till that date. Suppose in one of the 10 years or whatever, 12 years, 15 years, you have paid premium in 3 years more than 2,50,000. Done. Even 1 year more like 2,000. It is an asset. It is an asset. Then we will see how much amount you have paid till date. Let's say paid amount is 14 lakh. So this is the cost of acquisition, 14 lakh. You received from the insurance company 22 lakh. This is the consideration price. 22 lakh cost of acquisition, 14 lakh. Somebody may say, sir, that since it is more than 3 years, are we allowed to index the cost? Because indexation is allowed if it is a long-term capital gain. Sir, where will I be able to take the indexation? I said nothing to you. That's why. Where it is written? It is in section 112A, it said that like shares listed on a stock exchange, unit of equity oriented fund, there they have inserted ULIP also, to which exemption is not allowed. Saying that 112A says that it will be taxable at a special rate of 10%. 10% special rate, and therefore no indexation. Because 112A does not allow you indexation. So indexation not allowed. Straight away 22 lakh received, 14 lakh paid, 8 lakh will be your long-term capital gain. So this is ULIP. Is it clear, sir? Is it clear? Next is 219AA, read with section 72A. The government is going to go for disinvestment. They are trying to do one thing, that we will transfer undertaking or a division of undertaking to some other public sector company. And thereafter, and we will transfer the losses also. And thereafter, they will sell it. So point is demerger. Earlier, the definition of demerger, section 219AA says, demerger means the transfer of an undertaking or a division of undertaking by a company to any other company where 90% all the assets and liabilities of the division or undertaking are transferred for a lump sum amount, for a sum which is, I said, you get shares of the resulting company, the shareholder of the resulting company will get the share. Now they have said reconstruction or splitting of a public sector company by transferring the asset to the another public sector company. We will call it as transfer. We will call it as transfer. Sorry, we will not call it as transfer. Splitting of a public sector company by transferring the asset to another public sector company will not be called as transfer. And that means, therefore, there will be no capital gain. Though I have said now we are going to go disinvestment. The one division or part of a undertaking will be transferred to another public sector company by an existing public sector company. Since you are transferring the assets and liabilities, it should be regarded as transfer. They said no, it will not be regarded as transfer. But then what will happen? The resulting company will issue share to the shareholder of the demerged company. And thereafter they said, look here, that now since it is not a transfer, losses must have also been transferred. So section 72A says the losses of that company which are transferred shall be allowed to be carried forward for fresh 8 years. So they are going to disinvest, they are going to transfer, they are going to split up, they are going to reconstruct the public sector company by transferring the asset to the another public sector company, and they are saying it will not be regarded as transfer. Since there is no transfer, there is no capital gain. So they have said this, and they have also said that in this case, we will allow you to carry forward your loss and for the fresh 8 years, and this is given in section 72 capital A. So this was the next change. Next change. Look here. These days, what is happening? The rich employees are contributing to the Provident Fund. We call it as employees' contribution to Provident Fund. Try to listen it carefully. Employees' contribution to Provident Fund. Employees, I'm not talking about employer, employees' contribution. Now the rich employee used to contribute lot of amount for Provident Fund. So there are people who are depositing the whole amount of salary in the Provident Fund because they have other sources of income. Suppose I deposit in the Provident Fund 20 lakh rupees in a year. I put my salary there. although I'll be getting a reduction of 1,50,000 under ETC, I'm not allowed to assume more. Then, but they say his interest is different. His interest is not to take exemption. His interest is that 20 lakh minus 1,50,000, 80,50,000, he is earning tax-free interest. Tax-free interest, because he got deduction of only 150, but 18.5, which he has invested more, is earning him, instead of keeping in a bank where it is taxable, he has kept it in a provident fund and it is a tax-free income. Now they have said, look here. Any employee contribution to provident fund, if exceeds 2,50,000, then the interest on the excess contribution shall become taxable on accrual basis. Because you have paid 25 lakh, 1,50,000 is exempt. That is a different story. But they say, whatever interest you are going to get on 23,50,000, 25 minus 1.5, whatever interest you get, that interest shall also become taxable on accrual basis, because you are contributing more than 2,50,000. This is section 10.11 and section 10.12 where the changes have been made. Is this clear, sir? I need some people in front of me so that I might see the face and understand whether they are understanding or not understanding. So back, Mr. CICA is back. Oh, I don't know, gentleman name must be Arun. And I have Vishan from also they are back. So I try to understand now. So this is clear that if an employee contributes more than 250, the excess amount on which interest is receivable shall become taxable, the interest on excess amount. Because otherwise you would have kept it in the bank. If you keep it in the bank, it is a taxable interest. You are keeping in the provident fund, it is tax-free. So why should the benefit be given to only employees? You, me, are only getting a benefit of public provident fund, which is 1,50,000. He also gets the benefit of public provident fund, but employees' contribution to provident fund, why should it be more? Because if they invest more, they are going to get tax-free interest on the amount so deposited. So they have restricted it to 2,50,000. About 2,50,000, you will be liable to pay tax. Clear? I'm proceeding further. Section 1023C. What really happens is, in the case of charitable institutions who are covered under 1023C, 3IAD, 3IAE. What is this 3IDAD? You know that, but you don't know the section, you don't know the subsection, and you don't know the clauses. But I will tell you. What is this? Any income of a university or an educational institution, not for making any profit, but for imparting education, shall be exempt if the gross receipt do not exceed 1 crore. Am I right, sir? Do not exceed 1 crore. Similarly, next section 1023C3IA says, income of a hospital or medical institution, not for any profit, but for philanthropic purposes, shall also be exempt if it does not exceed 1 crore. Earlier it was 1 crore, it is now made to 5 crore. So 1 crore limit has been raised to 5 crore. Clear, sir? What is the advantage? In case you are a 1 crore or 5 crore, the advantage is you don't have to go for approval by applying. You don't have to go apply 85-15%, no condition of 85-15. You have no question of any corpus. Whatever amount you received, you just have to file return of income. That is mandatory. Even no audit is required. 10BB also not required. So that was the benefit which has been raised now from smaller school to little bigger school, having turnover, having gross receipt not more than 5 crore. But one thing they have added, that if the trust is running only educational institution, 5 crore. If the trust is running only hospital, 5 crore. But if the trust is running both educational institution and a hospital, then aggregate 5 crore, not 10 crore, 5 crore. Maximum is 5 crore. Clear? I'm proceeding further. Now, many changes in what you call charitable trust. You know, corpus donation that is specific, that is voluntary contribution with a specific direction that it will form part of the corpus of the trust is exempt under 11(1)(d). You know that it is 11(1)(d). Till last year, corporate donation under 1023C was not exempt, but I told them that you have to give this. So they have done. The corpus donation received under 1023C is also exempt. That is one. Now they said, clear, it is exempt. No doubt, you have to keep this money of corpus fund in 11(5), in a mode under 11(5). Earlier, there was no mode prescribed and people were misusing the funds. Now they have clearly said corpus fund will be exempt only when you keep that money in a mode mode given under 11(5). 11(5) mode mein rakhiye, it will be completely exempt. Now, next point is, sir, corpus donation is already exempt. Am I right? Corpus donation is exempt. Now, if you apply any income out of the corpus fund, why should it be exempt? It cannot be treated as application because you can't take two exemptions. One at the receipt of the income, next at the application of income. Because it is an income which is exempt. Then exempt income you apply, why should there be exemption? So they said, if you spend any money out of the corpus fund, which is lying in 11(5), we will not give you exemption. But don't worry, it will not be treated as application. Don't worry. Suppose there is a judgment, there was a judgment which is also overruled, and the judgment Subro's Foundation. Subro's Foundation judgment is there, Delhi High Court. In this case, what happened is, this Subro's Foundation spent money during the year 3 crore. They got their income during the year, received during the year 3 crore. But they spent rupees 360 crore during the year. 60 lakh must be their accumulated fund, which they have utilized. The law says, the application 3 lakh, you have utilized 3,60,000, excess application. It's not a loss. It is excess application will be allowed to be carried forward as per the Supreme Court ruling in the case of Subro's Foundation. But now please note, they have overruled this judgment. They say that if employee, that what are you doing is this application, which is exempt. Now, the law says it is going to be, it is not application. When it is says you are applying corpus for some purpose, why should it be application? There cannot be double exemption. First, you are taken an exemption while receiving the income. Second time, you are taking an exemption while applying the income which is already exempt. A taxable income you apply, you take exemption. Exempt income you apply, why should there be exemption? That was the point. And they said, you are allowed to carry forward. He said, wait. I spent 2.5 crore. Current year income 2 crore, excess application 50 lakh. He said, look here now, please try to understand. If you use corpus fund, which is lying under 11(5) for that 50 lakh, you have used the corpus fund for that 50 lakh, which is extra money. We will not treat that 50 lakh application of the current year. We will not treat, but don't worry. But in future year, if you reimburse the corpus fund by bringing back that 50 lakh rupees, we will treat as application. Suppose next year you are able to bring back 30 lakh application. Subsequent year you are able to bring back 20 lakh application. Are you getting my point? So in a way, you are able to carry forward. What if you have used that money out of corpus fund and you keep it there, but it will not be treated as what you call, you will have to carry it forward and then you refill, bring back that money as if you have taken a loan from the corpus fund, give back to the corpus fund, we will give you exemption. Clear, sir? There's a new thing which has happened. Next, very important thing. Very important. Now, most of the time I used to ask the chartered accountants and they used to give different answer, which I never agreed, but they still continue to give that answer. So I got the law change. What is the point? Suppose, Mr. Parmasivan, you have 2 crore in the bank lying of a school college, 2 crore in the bank. You want to purchase the building for 5 crore. So you took a loan of 3 crore from the bank and purchased a building of 5 crore. So what is the amount of application? How much amount you have applied? Most of the chartered accountants are saying, since I have purchased the asset for 5 crore, my application is 5 crore. No, sir, it is absolutely wrong. It may be correct from income tax, from accountancy point of view. It is not correct from income tax point of view. In accountancy, you have purchased an asset, so 5 crore is the asset. Balance, bank balance gone down by 2 lakh, okay. And 3 crore you will show in the asset liability side, so you are 5 crore is the application, but it is not application. Why? The loan which you have received is not an income. Loan is not an income. And if you apply that loan for the purchase of something, it is not application, because double application not allowed. So now what they have said, that you will be given exemption of 2 crore only, the money which you utilize, 3 crore is a loan. But wait, whenever you refund that loan, we will treat as application. In future year, when loan is refunded, we'll treat you application. Even the interest is paid for the loan, it is allowed. But what is there? Loan is refunded. You will allow it. Correct, sir? Loan repaid back, that will be application. So next point. I have done 1023C. Next point is...
Sir, one second. There is a question which has been asked by Mr. Ramesh Natarajan. He's asking please explain what is the language difference under section 1023C 3AD, receipts from university, etc., substituted by receipts of the person from such university.
The language used is that earlier trust had 5 institutions and each institution less than 1 crore. They were giving benefit for each institution. Now aggregate amount should be 5 crore. You have 10 institutions, 1 institution, 2 institutions. It will be aggregate 1 crore. Are you getting my point? That is the change which they have done. And they have done one more change. Now, if you are trust carrying on only educational activity, 5 crore. If the trust is carrying on only medical activity, 5 crore. If the trust is calculating both medical as well as education, then the aggregate will be 5 crore. It's not going to be 10 crore. The aggregate is going to be 5 crore. Clear? So this is what I'm trying to say. Answer is correct. Now then, any other question?
Yes, one person is asking, Mr. Shantanu, suppose we buy a capital asset out of the Corpus fund, can we claim depreciation on its application?
Sir, when it is exempt, how can you claim? You are applied what? You are applied exempt income. How can you claim it as an application? No, it is already decided. No, if you take depreciation, we don't allow you, we don't give it as application. But the money should be utilized, the taxable income. When you are utilizing the exempt income, where is the question of application, my dear? Where is the question of application when the exempting? How can you take 2 exemptions? One exempt income exemption, second income applied again exemption? Not possible. First take it taxable income, then apply, you call it as exempt. 2 exemption cannot be given. That is the point. And depreciation, if you have taken from Corpus, no question of depreciation, no question of application. But one good thing they have done, that if you refill the Corpus in the future year, we'll give you the application. Right?
Okay. So that's it, sir. As of now, that's it.
Now, next section. 36(1)(VA) used to say employee contribution to the Provident Fund or ESR or any other welfare fund shall be allowed as deduction if the payment is made on or before the due date under respective act. Please note the word under respective act. But there are so many judgments of the High Court, starting from Delhi Judgment Amal Limited, where they said that if you make the payment before the due date under 139(1) given under 43B, we will allow you that deduction. 43B. That was wrong. But 12 courts judgments are in our favor. Gujarat High Court judgment is against us, and one more, Rajasthan. Now they have put an explanation under that, under 36(1)(VA as well as 43B. Under 36(1)(A) it is written that the due date mentioned under 43B has nothing to do with the due date mentioned in the 36(1)(b). This due date is 15th of the next month, the Provident Fund. Even 1 day delay, the deduction will not be allowed. So that overruled, now as explanation added. Please note, deposit the PF, deposit the ESI within the request, within the due date, due date under respective act. Otherwise, you will not be allowed any deduction. Rather, it will be treated as your income. You will be treated as your income. And in 3CD form, you have to tell that this is your income. Correct? This is 36(1)(b)(a). Next change. I have not done anything. 44 AD. Limit of 1 crore, which was raised to 5 crore last year, has been raised to 10 crore. And 70% chartered accountants are saying that our 70% or 80% return was for less than 1 crore, and we were auditing the accounts and we were getting the revenue. Yeah, and not only this, even GST audit is gone also. Double, baby. You have lost this, you are going to lose that. I'm not concerned with GST audit, but let me tell you, the audit which you are doing for less than 10 crore companies, they were not maintaining proper records. They were not having good inventory records. Rather, we were taking risk of signing their Form 3CD and CA. What is happening is, most of the time, they are not able to give us complete information. And what we used to do is, NA, not applicable, not applicable. 50% of your 3CD is not applicable, although it was applicable. But that risk is now gone. At least you will not have to bother about that part. But otherwise, full risk, no 3CD is correct. I'm telling you, no 3CD is correct. But we were still doing it. But sir, what happens? Our revenue gone. Like, what are you talking? Are you getting separate revenue income for that? You are getting a lump sum fee of 1 lakh, lump sum fee of 2 lakh, lump sum fee of 50,000 for doing audit, doing tax audit, doing income tax case. Nobody gets separate for what you call. So it is gone. You should be happy. You will get your fee, but you have no risk in that. You are absolutely no risk in that. Earlier, you had a lot of risk. Somebody said, sir, I was charging separate amount for tax audit. Said, no problem. No problem. Let me tell you. He said, I will do the audit. And I will not let the client know that it is not required. I said, look here, my dear friend. If you do the audit and it was not required, the due date of filing the return will be 31st July. Please note 31st July and not 31st October. And for report 30th September. So it is going to be July because it was not required under 44 AB. You are doing yourself. So he said, sir, that means carry forward losses will not be allowed? Because certainly not allowed if you file late. Sir, that means even deduction under 80IA onwards not allowed? I said, certainly not allowed. So don't take the risk of doing an audit which is not required under the law. You will be otherwise putting yourself into difficulty. So I can't help it. I can only say whatever God does is for the best. So, theek hai. Now, let's see what happens. Institute is represented, but I don't think they are going to listen. They say, no, it is digitalization. And in digitalization, everything is there. And we have 360-degree profile. Why should we go for audit? And we are giving this incentive to the client. Why? We want them to go for digitalization. 95% the payment and 95% the receipt should be in a mode other than cash. That's why they are giving incentive. Even in 44 AD, instead of 8%, they are saying you can presume your income to be 6% if you are doing everything digitally. So this is the reason they have done it. But don't bother. Don't bother. God is kind. He will look after. Don't worry. Don't worry. Next point. 45.4 and 45.4a. Earlier, there was only one section, 45.4, which used to say that if there is a dissolution of the firm or other dissolution or otherwise of a firm or AOP, then there will be a capital gain in the hands of the firm, capital gain in the hands of the firm because of dissolution, and we, for purpose of computing capital gain, will take the fair market value for that and calculate the capital gain in the hands of the firm. Now, what people were doing, one, it was written dissolution or otherwise. They used to say only dissolution is covered, retirement is not covered. Second, what they used to do is they used to revalue the asset and then they go for dissolution. Now they have told us, we are making into two sections. 45.4. You have a capital balance of 60 lakh. Please note, it should be without indexing, without revaluation. You have a capital balance of 60 lakh. And for this capital balance of 60 lakh, you are going to give any asset. A firm could be going to give any asset to whom? To the partner at the time of dissolution or reconstitution. Even retirement is also covered now. At the time of reconstitution, retirement covered. Now, there will be a capital gain in the hands of the firm. And for purpose of computing capital gain, the consideration price shall be the fair market value of that asset, which you have given in kind. So this is against his capital balance. Now they have added 45.4a, that suppose capital balance is 60 lakh. You want to give him 80 lakh. Why are you giving 80 lakh? Earlier it was not there anything. Now they say if you want to give more than its cost, more than its capital, the excess amount which you have paid shall be a capital gain in the hands of the firm. That means 20 lakh which you have paid extra, the firm will have to pay capital gain tax on that 20 lakh. Is this clear to you? Is this clear to you? To section 45.4, 45.4a. 80EEA. You know, there was a case of that if you buy an affordable house, and you take a loan for buying an affordable house, and you do not have any house, residential house earlier, then if you take a loan and loan is sectioned up to 31st March 21, you will be given an additional deduction of interest of the amount of 1,50,000. Was there 1,50,000? But because of COVID, no loan was sanctioned or they did not buy any house. So they have extended this period. The loan should be sanctioned by 31st March 22. We will give you a benefit of interest deduction under 80EEA amounting to rupees 1,50,000. So 1 year extended. Next thing, 80IBA. 80IBA is affordable housing. You know, if you are in the business of building and of affordable housing, 1 minute, can you give me 1 minute? If you are in the business of developing and building the affordable housing, and the value of each house does not exceed 45 lakh, you were given 100% reduction of the profit from this activity. But here also the project should have been sanctioned by 31st March 21. They have extended 1 year for 31st March 21 so that you can do it up to 31st March 22. One thing they have done, our Prime Minister, Mr. Modi, said lot of migrant labor go to the different cities, coming from Bihar, coming from Kerala, coming from various parts of the city, villages, and they go to the city. They are not able to buy the house, and even the rents are very high in those cities. He said, why not go for a affordable rental housing project? Affordable rental housing project should be constructed by the builder. Small houses, one room set or whatever may be, and rent should be cheaper. So whatever profit you earn from that affordable rental housing project, we will give you deduction of exemption also for that, deduction of that under 80IBA subsection 1 capital A. This was done. Next thing. Now, sir, a good thing, a thing for relaxation of chartered accountants. They work very hard and they work throughout the year. Sometimes they file return up to 31st March. Or there is a belated, some revised return. You are allowed to do up to 31st March. Now look here. that belated return or revised return now will have to be filed before the end of 3 years, prior to the 3 months from the end of the assessment year. 3 months from the end of the assessment means after 31st December, you will not be able to file any return after 31st December of the assessment year, whether it is belated return or it is a revised return. So you are free, my dear, on 31st December because all returns gone. Celebrate your new year. All returns gone. Earlier, you used to wait for revision maybe up to 31st March, belated up to 31st March. Now, no work of income tax after 31st December. Somebody told me, sir, what about the assessments? The assessments are pending. I said, wait, 153 also changed. Earlier, time barred cases were 2 years, then brought down to 21 months, then brought down to 18 months, then brought down to 12 months. Now it is 9 months. Meaning thereby, even the time barred cases will be over by 31st December. So where is the work now? So income tax free, time barred free, audit is only after 31st March. Because audit, it is only internal audit will be there. So you can enjoy now. Chartered accountants can now enjoy. Take your family. Enjoy first New Year Eve. Yeah, take your family, go for holidays. Earlier, there was no question of any holiday. At least your wife will be very happy. Now you have some time for relaxation because no work after 31st. And you cannot give the excuse also. No, we are very busy in the office. We have to do a lot of work, some belated return, some revised return. Now she will come to know. No question of related return, no question of revised return. Everything is over on 31st December. Clear, sir? Should be happy. Whether you are happy or not, I am very happy. 31st December, I'm free. Earlier, you keep on dragging. And sometimes you want to. Another very important, Mr. Parmeshwaran, another very important thing. What has happened? Earlier, sometimes you intentionally were not filing a return. There is a return of the SSC you never wanted to file. Why? You used to tell, let us wait for scrutiny. The scrutiny notice will come only up to 30th September. So let us pay a fine, but we will wait. Because if the scrutiny comes, we'll file return in this manner. If the scrutiny does not come, we'll file return in this manner. You used to do it. Now, the scrutiny notice will also not be served to you after 30th June. So relax. Now file their return on 31st July. Now no question of waiting. Firstly, you used to wait for September for filing a return, thinking that we have shown something there. There may not be a scrutiny. And if there is a scrutiny, the next year return should be filed in a proper manner. But relax. You don't have to do it. Clear, sir? Another relaxation. When you used to go for search, there was the assessment under 153A and 153C, where 6-year case could be reopened. 6-year case could be reopened. And besides 6 years, they could go back beyond 6 years for 4 years. If any or aggregate of 4 years, the income scale was 50 lakh or more. Am I right? 50 lakh or more. Now, maximum 3 years, even if search case, 3 years. But they can go beyond 3 years also for 7 years. But wait, only that previous year in which the income scale is 50 lakh or more. It's not aggregate now. Pehle aggregate of 4 years was 50 lakh or more. Now it is not aggregate. 3 years is fine. 3 years is okay. You will have to file return for 3 years. Beyond 3 years, although they can go up to 10th year, but only they will pick up that year for such case where the income scale is 50 lakh or more. If in those 7 years, income scale is not more than 50 lakh, they will not take up that case. This is one benefit for such cases. But for normal cases of reassessment, earlier the period was 4 years or 6 years, maximum 6 years, otherwise 4 years. Now they can go beyond 3 years also. Period is 3 years now in reassessment also. But they can go beyond 3 years. For how many years? 7 years more. Earlier, the maximum was 6. Now you can go up to 10 years. But in that particular year, which we are going to reassess, the income scale assessment should be 50 lakh or more. So if it is less than 50 lakh, it is only 3 years. If it is more than 30 lakh, they can go back. So this is also relief. Another relief, try to understand. Earlier, you were given a notice under 142-48 because they had reason to believe that income has escaped assessment. You were told to file a return, and you used to say, kindly provide me the reason. They said, no, first file a return, then we will give the reason. And after giving the reason, you used to file objection. After disposing the objection, if against you, they could do under 147. Am I right? Now, a new section 148 capital A has been inserted, saying that if it is a normal case of reassessment, they will tell you that this is the reason. They will make inquiry, they will make investigation, they will give you show cause, kindly show cause why this income be not treated as income escaped from assessment. You will be told in advance. It's not that you will have to first file a return and then you will be told. You will be told, but you will be given opportunity of being heard. Then they will decide whether it is a genuine case for reassessment or not, and then they will do it. Then they will do it. This is 148 capital A section which has been inserted. But this section is not applicable for search cases, survey cases, because they have already done investigation. They've already done inquiry. So why should it be given an opportunity to? But if it is a normal case of reassessment, they will give you an opportunity to explain why this income be not taxed under 147. And then they will issue the notice. So this is also advantage. And due to that, section 147, 148, 149, 151, 153 have been modified, changed. And they have introduced one more section, 148A. That's all. The next one. Now, Paramashivan at the beginning said a very great thing has happened. Sir, what great thing has happened? He said that a person of 75 years above will not have to file return of income. What is so great about it? Tell me. 75 years. It's not that 75 years is not tax-free income. They have never said it is tax-free. It is not report to file return, but they have not seen the condition. The condition is there should be only two incomes. One is pension income. The other is interest on bank deposit. Only two. And that too should be in the same bank. You cannot have in different banks. Branch can be different, but at the same bank. Because the bank is supposed to deduct the TDS. How can two banks deduct the TDS? So it has to be same bank. Now that means that is a poor man. He doesn't have any other bank account. He has only two income. One is what is called pension income. Another is bank deposit. If he has interest on post office deposit, what will happen? If he has dividend income, what will happen? If he has house property income, what will happen? If he has the mutual fund income, what will happen? If he has so what is the use? And what is the time taken to file a return of this man? 2 minutes, form 1. Pension, interest, upload it. And we chartered accountant are filing more than 50% return complimentary during 31st July. More than 50% returns are complimentary. Am I right or wrong? And most of them is either our relative or our friends or the government officers. We file return complimentary. And the point is they will come only last days, either 29 July, 30th July or 31st July. And if they come to your room, you say, please go out and get that gentleman is sitting, get the return filled. Then the comment is, because we don't pay anything, you want us to get the return filled up by somebody else also. So we have to make them sit in the room. We have to serve tea to them. We have to serve biscuits to them. And we have to hear about them, what has happened during 1 year from the last visit to this visit. They will waste you a lot of time. Then again, you will say, okay, I have seen. Please get it filled up because I am not able to do it. You get it. Then after filing, he'll come back. Sir, please check it. My God. And after 1 month, you will get a phone call also. Sir, my refund of 200 rupees has not come. My refund of 500 rupees has come, as if we have to run about for his refund. So what kind of a thing is this, I tell you? But we are doing it. We are chartered accountant, not lawyers. We are doing lot of charitable activity. So what I'm trying to explain, that too will take 2 minutes. So what is the concession? I hardly feel any concession given for 75-year-old, because they have to file two tax already deducted. How much time it is going to file a return, sir? I tell you. Chaliye, next one. Now another point. Our clients are great. You know, sometimes what happens, when a contractor gets lot of payment from the tax deducted is Mr. Parmasivan is back. But at that time, he was not there when I said this thing, that there is no benefit of 75%. I said, hardly. It's only for beating the desk. Oh, very good, very good. One thing has happened. It is not a tax-free income. It is only that you don't have to file a return. A tax you have to be paid. So how much time to file Form 1? It doesn't take much time. And let him come to you. You will do it, because you have been doing for many people. You are doing for many people. So you are going to do service for 75 and above. Put a board out here outside your office. Free return for 75 and above. It's better than that, than doing it. Okay, let me come back. Now, TDS is deducted on the contractor payment, maybe 1% and 2%. Am I right? But many of them do not file return. After even deduction of tax, they said, okay, enough. We have given to the government 1%. We have given to the government 2%. Let us not file a return. Even if you take a generator on hire, the TDS is 2%. They also don't file a return. Furniture on hire, they also don't file return. Now a new section has come, sir. Section 206AB for TDS and Section 206C for TCS. Now what has happened? If you are supposed to deduct TDS, let's say, you are a deductor. When you deduct a TDS, you find that this gentleman has not filed return for the last 2 years. Not filed return for the last. And the amount of tax deducted or collected is 50,000 or more in each previous year. In each previous year, 50,000 or more. Then in this case, you will deduct the TDS at twice the rate. At twice the rate. If the TDS rate is 5%, 10%. Promotion 10%. If the TDS rate is 10%, 20%. If the TDS is 1%, 5%. Minimum is 5, then twice the rate. Now the question which Mr. Paramashwan may ask, sir, how do I know that this gentleman has not filed return for 2 years? How do I know? How do I know the tax deducted is 50,000 or more? You are asking me to deduct the tax rate, twice the rate. You will be provided with a utility. You put your PAN number in the utility, PAN number of that person, it will show whether he has filed a return of the past 2 years or not, and deductible the rate. So the government is going to make it very simple. Just go to the utility, put the PAN number of that person, you will come to know. You will come to know whether he has filed those returns of 2 years or not. And if not, deduct twice the rate, both for TCS and TDS. Clear? Clear, sir? 234C. Now you receive dividend. There is no time for receiving a dividend. Sometimes you receive in July, sometimes in November, sometimes you receive in January, sometimes you receive in March. Now the problem is, how do we know? We have to deposit advance tax. How do we know that there will be a dividend or there will be no dividend? How do we know? Even capital gain cases also. So they have given a relief that 234C interest will not be leviable if you have received the dividend after the due date of giving the installment, provided you make the payment by the next due date. Suppose you receive dividend in the month of August. What is gone? June installment is gone. Pay that by September. You receive the dividend in the month of November. 2 installment gone. Pay that in December or balance in March. You receive the dividend before 14th March. Pay the whole by 15th March. You receive the dividend on 28th March. Don't worry, pay by 31st March. We will not charge you interest. Clear, sir? That is the benefit like capital gain. 234C proviso has been changed, I have told you. That also has been the another change. The next change. Last year, 271 AAD was inserted, stating that if there is a false entry, if there is a false invoice, if there is a, and it is found in your books of account that false entry or false invoice, you will be liable to pay income tax. You will be liable to pay 200% penalty under 270A, and you will also be liable to pay penalty under 271 AAD. And then they added subsection 2, that a person who helps him to get that invoice or who has connived with him, he will also be liable for penalty of 100%. Many chartered accounts are doing wrong things. They say you will also be liable for 100% penalty. Now they have added one more thing, 281B, saying that if this type of entry, the amount is 2 crore or more, you will be, the asset can be also what you call attached. The asset can, this also be given in GST. Same, they have brought it here. The asset of that person can also be attached. So I have covered almost all sections which were relevant for you. Now you have questions. You can keep on asking questions. I can answer those questions. Any question?
So in fact, one person was asked, what is the impact of 206C1H on account of the introduction of the proposed?
Oh, I'm sorry, I forgot. My mistake. 194Q section has been inserted. My mistake. I'll do that. You know, the 194Q says the buyer who makes a payment to the supplier of the goods is under an obligation to deduct tax at the rate of 0.1% of the value amount paid more than 50,000 or the goods purchase is exceeding 50,000, whichever is earlier. Who has to deduct? The buyer. TDS of the seller. Wait a minute. The definition of buyer says your turnover of the preceding previous year should be 10 crore or more. 10 crore. So I am a buyer buying goods from you. I am making a payment of more than 50 lakh or buying goods for more than 50 lakh, I will deduct TDS of yours, provided my turnover is more than 10 crore. Next, sir. 206C1H said, a seller of the goods at the time of receiving the payment from the buyer of the goods shall collect 0.1% if the amount received is more than 50 lakh. There the definition is of the seller. Seller whose turnover of the preceding previous year is 10 crore. Wait a minute. Earlier 194Q introduced turnover of the buyer is more than 10 crore. If the turnover of the buyer is less than 10 crore, then 206C1, seller should be more. So what I'm trying to explain, if my turnover is more than 10 crore, I'm buyer, 194Q will be applicable. If my turnover is less than 10 crore, I'll keep quiet. The seller will see what is his turnover. If his turnover is more than 10 crore, he will collect TCS about 50%. If both the turnover, both the buyer and seller turnover is more than 10 crore, it is the buyer who will have to deduct, not the seller. It is the buyer who will have to deduct, not the seller. And last, if the turnover of both are less than 10 crore, then nothing is applicable. Clear? Now, if he has a question on this, he can ask. Sorry, I missed it.
No problem.
Question on this, if they have.
1 second. So what they're asking is, what is the impact of section 206C1H on account of introduction of provision 184Q?
Simple question, impact. I will see, I am a buyer. I'll see whether my turnover last year is more than 10 crore or not. If it is, I will deduct tax. Then seller will not do it. Because seller will come to know I have deducted it. Seller will not do it. If my turnover is 10 crore, I will not do anything. Now it is the turn of the seller. Seller turnover is more than 10 crore and he has received more than 50 lakh, he will collect from me. Who will get the credit? In the case of TDS, the credit will be of the seller. In the case of TCS, the credit of the buyer. Then buyer should be less than 10 crore, seller is more than 10 crore, then it is 206C1H. And if both are more than 10 crore, my dear, it is 194 Q which is applicable, 2061H not applicable. Right? So preference is to 194Q and not this section. Clear? Clear? 1H will only come when buyer is less than 10 crore and seller is more than 10 crore.
Sir, I do have a doubt. That is, on account of 45, the section amendment, what will happen, suppose a family of partners, that is all the partners are same family members, on account of some family partition, some firm is getting, say, they are separating the assets. I'm not saying as a dissolution, but on...
You're talking about 44, 45.
45, yes. So on account of family partition, suppose we are segregating the assets. So in that case, also the same
Dissolution or reconstitution. You have to calculate, if the asset is given in kind, you will have to give capital gain tax.
Okay.
But if somebody retires and takes his capital and money, no question. You can take anybody else inside. You give him to the extent of the capital. Let anybody come into it, that goes. In a family partition, normally what we do is that instead of distributing it, the person retires and we bring new money in the business. Otherwise, in family partition, sometimes what really happens is that family partition is not a transfer. In a case of family partition, it is not a transfer. And income tax is not applicable in that case, if there is an agreement. But I would like that in the case of family partition, there is no question of company. There is no, you can't do the company. You can do the shares of the company to be gained, but company cannot be changed. So what I'm trying to explain, you can do family partition in this manner, but that partition should be recognized. You get the approval of the court, it is better. First you do MOU, then take the approval of the court, then they will not say anything.
Okay.
Sir, I have a question, sir, regarding a dispute resolution committee and the faceless
Oh, sorry. What has happened to me? I'm in a hurry to go. I recommended this, that settlement commission is over. They have said any pending case in the settlement commission, a board will be constituted, will complete it. But no settlement commission, because you used to get the thing settled. You know that, what it means, the settlement. That is gone. ITAT is also going to be faceless, 255. ITAT is also going to be faceless. Now you can't say, I know somebody in the ITAT, I know this person, even assessment case gone, even everything will be finished. Everything going to be faceless, whether rectification, whether it is revision or anything, penalty, appeal, everything is going to be faceless now, even ITAT. But we recommended to them, sir, lot of litigation is going on. You know, AO does goes for assessment, which may be blatantly wrong. High pitch assessment may be done. Now I have to go to Commissioner Appeal, I have to go to ITAT, I have to go to High Court, I have to go to Supreme Court, then the things get settled. Why not do one thing? Give an opportunity to the SSC and form a committee, dispute resolution committee. But this committee, according to us, which we recommended, should have some outsider also. Not only income tax department, some expert in the field of tax. They should also form part of that committee. Constitute kijiye. Then a draft order will be prepared by the AO, will go to the committee. You sit around, you talk to them, you explain your position, they explain your position, and then you make a settlement there. That yes, I'm ready to give this much of tax. That if you give that much of tax, no question of any appeal, no question of, if you don't agree, then go. But it will be solved there and then. And he knows that I am on a weak wicket. He will agree. If he's not on a weak wicket, let him go. Then it is his choice. No? So we wanted some outsider should also be there. For a trial, they have said return file should not be more than 50 lakh and the variation should not be more than 10 lakh. It is just a trial. But remember, settlement does not mean you sit across the table. It will be all online. It will be all video conference and it will be all recorded. So no question, sir, please do something. Nothing like that. You have to have clear on merit and no other thing. Somebody is asking some question, you can ask. You can unmute him because he's showing his hand. Any other question, please?
But before that, I'll just throw another question, sir. Whether the trust registered under Section 12 can take the benefit of 1023C 3AD if the gross receipts is less than
Why not? Because in future, they are told either you want approval or you want 12 AA. But 1023D is no requirement. You can continue to have 12 AA. You have to go to register from April. Please, re-registration is from next year because it has been postponed. Re-registration, you do it. Keep it with you. Don't file under 12 AA. File under 1023 3AD. No approval is required. You can continue. The moment you cross 5 crore, then you can go to 12 AA. Who stops you?
Can I? So can I? Go ahead.
Yes,
So
sir.
can I start?
yeah.
Whether a charitable trust like Rotary rents its hall for commercial purposes and say it is incidental to the main object, and if so, whether such income should be less than 20% of the gross receipts.
Sir, you are a charitable organization, but you are not coming under the first 6 limb. It is not a relief to the poor. It is not education. It is not yoga. It is not medical relief. It is not preservation of any monument or preservation of any wildlife or forest or anything. So what is, you are covered under advancement of any other object of general public utility if you are registered. And in the advancement of general public utility, any commercial activity, the total receipt 20%, you will be covered under, you will not be allowed exemption for that amount. At all, you will not be allowed exemption under section 1112.
If it is more than 20%, we won't be allowed. If it is for general public utility, like Chamber of Commerce and other. Yeah.
Now, if
But
it is a mutual, if you are a mutual association, whatever amount you contribute yourself, that is not taxable. Whatever amount you are earning from person other than members, it is fully taxable, even bank deposit. You can form a mutual association where the members contribute and you spend the money on members. But if you are receiving any money from person other than members, you are receiving money from bank, income from, or anything, rent from other than members. You know, a club is a mutual association. The club renders service to the members. There is no tax on club. But if the club gets every interest income, it is taxable. If the club doesn't give what you call rooms to the outsider, they give room to the member. They give facility to the member. Although they are charging money on account of the food served, but they say it is mutual character, no income. But that should be only mutual. Whatever you earn from person other than member, then it is taxable. And mutual association should also be registered somewhere. It could be a registered society, registered under Society Registration Act, or it may be a cooperative society registered under the Cooperative Society Act. If it is no constitution, or it will be Section 8, but mutual. If it is not mutual activity, you can't have more than 20% if you are covered under advancement of any other object of general public utility.
Sir, I am Parthiban Chartered Accountant, sir. Good evening, sir.
Good evening.
While talking about corpus donation, you were told that refilling of corpus. What is meant by refilling, sir? You explain.
Sir,
but
I give you an example. This year, your receipts is 3 crore.
Okay, sir.
You have spent rupees 3 crore 60 lakh.
Okay.
Now, this money of 60 lakh should be spent out of the corpus money, which is lying in 11.5. Lying in 11.5.
Right.
Correct?
Okay.
This year, we will not give you any deduction of that 50 lakh. The exemption will be 3 lakh, not 350.
Okay.
You have used the corpus. Now, next year, out of the current income, you refund the money to the corpus. You put back, refill the corpus to the extent of 50 lakh. We'll give you exemption next year.
Okay. Okay, sir. Thank you, sir. Thanks a lot.
Regarding NRI, sir. Regarding NRI double taxation, can you explain, sir? Regarding what are
Okay. In this case, there is no double taxation. But whatever is the double taxation, you have a treaty. Go for treaty. There is a treaty, double taxation agreement. Go for the treaty. And in the treaty, you have paid tax in a country where other country, and you are a resident country. The resident country give you the credit of the tax which you have paid in the other country. That is the treaty is there. So suppose I have an income I am a resident of India. I have income in US. I have an income in UK. And I am a total, because I'm a resident of India, the global income is taxable. I have to pay tax on UK income also, USA income also. We have a treaty with USA. We have a treaty with UK. They might have paid tax there in that country. We give them credit of the tax paid in that country or tax payable in India, whichever is less. If they pay 25% there, they are chargeable here 30%. We give the credit of 25%. If there it is 40%, our is 30%, we'll give him the credit of 30 only. Na? How can we give 40? That is called double taxation of identity, giving the tax credit which they have earned, they have paid in a foreign country, because that income is also going to be taxed in India.
In the budget, finance minister also told that she may add some additional rules regarding NRI double taxation. The NRI who was retiring from abroad countries.
Sir, that is retirement. The
NRI.
retirement fund which you bring, retirement fund lying there, they will tell you what is to be done. That is the NRI retirement fund. Because retirement fund, there it may be exempt. Here you say, no, it is taxable. It is the income which is, so they will tell you about retirement fund. You wait and watch for some time. That is the rule which will come.
Any other queries? So, but as regards to the payment of the employee, that is the PF or ESI, that is going to be prospective or retrospective also, sir?
As per the explanation, when you add legal is that it is applicable from the date when the section came. But don't worry. This government has given an assurance that we will not make it retrospective. So they will not issue any notice to you. No, old cases will not be opened. But wait, whatever the case is pending, that the appellate authority will decide. They will agree to that. If the appellate gives their decision in your favor, you'll get the relief. If they don't give the decision, you have to pay tax. But in future, they are not going to listen.
They're not going to get. Okay.
That's all.
Right. So, any questions from the members? Else we'll. Okay. So, thanks a lot, sir. So now I request CAK Vishakan, Kumbhakonam branch chairman, to give the vote of thanks.
Good evening, everyone. It is my privilege to propose vote of thanks for today's webinar. I would like to thank our webinar speaker, CA Dr. Girish Ahuja ji, for visiting and enlightening us with their knowledge. Today's webinar was full of knowledge and it gave deep insight into the topic. Sir, thank you, sir. You wonderfully explained by clause. You already explained 10 minutes regarding tax audit, time limit, and what are the relaxation the Chartered Accountants has during time limit for processing the returns and scrutinizing, depreciation for goodwills, ULIP, PF, senior citizen. You explained in a very beautiful manner, sir. I once again thanks, sir.
Thank you.
I once again thanks our speaker for his excellent speech about union budget. My special thanks to our chief guest CA Dunkar Chanjain, chairman of SIRC, for his special message. I want to thank the management committee of Trichy and Kumbhakonam for their support. And I also thank you all the ST members to present here. And
thank you, sir.
Thanks a lot.
Take care. Thank you. Good night. Thank you. All the best. Take care.
Thank you.
Thank you.
Thank you, sir.